Trucking businesses have been told for years that the S corporation is the ultimate tax hack. However, with the big beautiful bill having just been passed back in July, I don't think that going forward the S corporation is going to be as much of a slam dunk as it's been before in terms of saving owner operators, fleet owners, lease operators money on their taxes, and I think it's actually going to end up costing more people more than it ends up saving them. If you guys are new here, my name is Fahad. I am a tax accountant, IRS licensed enrolled agent, and QuickBooks Pro advisor. I run a virtual accounting firm based here in New Jersey, and I help owner operators, lease operators, fleet owners, company drivers optimize their taxes and keep more of your hard-earned money in your pockets at the end of each and every tax year. Enough of my intro, let's get into the video. Why is it that I think the S-Corp might be dying? So first of all, we have to understand one of the provisions that was put into the 2017 Tax Cuts and Jobs Act that President Trump signed, which was QBI, Qualified Business Income. What this deduction was a 20% deduction on all pass-through income. Now, the three business entities that qualified for the pass-through deduction were sole proprietorships, partnerships, and S corporations, not C corporations. So only pass-through entities where some of the income or all of the income is passing through to the individual owner of the company, it's passing through to them, they are eligible for the QBI deduction. Now, there are some limitations in terms of like what's called the SSTBs, Specified Service Trade or Business. However, for trucking companies, that is not going to apply. So the QBI deduction was and is still very huge. It came out in 2018 and it was scheduled to expire in 2025. However, the big beautiful bill passed back in July, and the QBI provision has now been made permanent in the tax laws, which means, at least for now, for the foreseeable future, anytime you make money on a sole proprietorship, a partnership, and S corporation pass-through income, you are going to be able to take a 20% deduction on that income. So traditionally, you would go from having a sole proprietorship where all of your income is taxed, right? So you have federal income tax and you have FICA, Social Security, Medicare, payroll taxes that you're paying on the whole amount. So the S-Corp play, if you will, was to take that sole proprietorship, convert it into an S corporation, and then have that income. Basically, you're making the same amount of money, and then you're saying, okay, we're going to split this income into two. Part of it is going to be a salary. You're going to pay federal income tax, and you're going to pay your Social Security, Medicare on that portion. And then the last portion, you're only going to pay federal income tax on that portion, which means, generally speaking, people saved a good chunk of change on the payroll taxes because, again, you're splitting the income in two. Part of the income is having two taxes placed on it, while part of the income is only having one tax placed on it. Now, here is the QBI catch. For QBI, sole proprietorships and partnerships are able to take the QBI deduction on all of their profits. So if you have a sole proprietorship, for example, that made $300,000 gross, $200,000 in expenses, and $100,000 in net profit at the end of the year, the sole proprietorship is going to be able to take a 20% tax deduction when the income actually flows through to the owner. However, when it comes to S corporations, you are only allowed to take the QBI deduction on the portion of the money you're getting from your company that is not a salary. So if I set my salary, for example, at $50,000 and I take $50,000 in distributions, yes, sure, I'm not paying federal income tax on those $50,000 of distributions. However, my QBI deduction is now $10,000 instead of $20,000. So the more you have in terms of W-2 income from that S corporation, the smaller the amount of money you're actually going to be able to take the QBI deduction on gets. And because this QBI deduction has now been made permanent, we might run into situations where the sole proprietor is actually doing better than the S-Corp for tax purposes, because the sole proprietor is not limited by how much they took in payroll. They're able to take that 20% deduction on all of the money that's coming in to them in the form of profits. Now, of course, this has been talked about many times, but S corporations also come along with a lot of additional overhead, things like compliance, accounting, tax preparation costs. You also have to pay for things like payroll software, running your own payroll. If you have a bookkeeper, they have to do it for you, as well as additional IRS scrutiny over what exactly counts as a reasonable salary. Because QBI has been made permanent, it might actually be better for you to stay as a sole proprietorship for longer as opposed to go down the S corporation route. Now, of course, the S corporation can still make sense if you are making high enough profits that you can actually beat the QBI deduction with the savings on self-employment tax, or if you're already running a fleet, you're already running a team, you've already got drivers, you've already got people on your payroll and staff on your payroll, where you're already bearing the payroll costs and all these compliance costs anyways. S corporation might in that case actually be a better option for you. Or if you're planning to really reinvest in the business and pay yourself a very modest IRS approved salary, then you would be able to take more of the income as distributions. Then you would still be able to get a pretty good QBI deduction on your taxes. But in terms of the blanket, you get an S corporation, you get an S corporation, she gets an S corporation, he gets an S corporation. In terms of that advice, I don't think so. I think that every case needs to be analyzed on a case-by-case basis. Everybody's situation is different, and the S-Corp is not really the one-size-fits-all solution that it's been marketed as for many years. Now, I have included a link below to a website that I actually use myself for my clients. You can actually go in, you can look and run the numbers on each of the different types of classifications. So S-Corporation, C-Corporation, partnership, sole proprietorship, and see how much you might be saving in terms of payroll taxes, in terms of federal income tax, and also whether or not that having that QBI deduction actually changes things for you. Truckers, I hope you found this content helpful, and I hope that you will be mindful of the decision of when you should become an S corporation. Understand that there's a lot of factors involved, and you should definitely check with a professional to make sure you're making the right decision for you. Truckers, stay safe out there on those roads. Keep America moving. God bless.